Oh, sure.
All right, thank you. Welcome, everybody. Thank you for attending this presentation. I want to welcome everybody to Money Matters, How to Thrive and Survive in College and Beyond. And today we're going to look at Financial Literacy 101. So some really good basics for you to take and be able to apply that in regards to credit and how you can use it and sort of the different impacts it has and what to look for when you're first entering the world of using credit. My name is Gene Miles. I am, second here, pardon me. My name is Gene Miles, and I am manager of sales and service here at Rapport Credit Union. We're a division of WFCU Credit Union, and we're located down at 945 Stockdale Road. And I say down because we're just down the hill from you locally here, and you are more than welcome to attend and see us here at the branch after this. So what we want to touch on today is, as I mentioned, the credit management part of your life, I guess, in college and as you move through college, and some of the things you should be aware of as you move forward. As we know, credit can sometimes feel overwhelming, but learning to manage it effectively will give you more control over your financial situations and financial life. Credit is a valuable financial tool when used wisely. Understanding the different types of credit, like personal loans and credit cards, is credit and how to use it in a critical way and how to use it in your daily life. Today, we'll discuss how to use credit effectively without letting it lead to financial stress. And we'll also focus on understanding and the terms of loans and credit products so that you can borrow without compromising your budget. Wise use of credit can be a valuable tool, as I said, and without knowledge and care, it can prevent people from getting control of their personal finances. It's also important to understand different types of credit are available, their purpose, how they work, features, associated costs, advantages and disadvantages, the real cost of borrowing, how your needs and wants influence your use of credit, what the credit report is, and how to improve yours, what to do if you run into problems, and how to determine an appropriate amount of debt for you. I'd like to next explore the pros and cons of using credit. So let's talk about the pros first. So if you purchase large items that would take a longer time to save for, um, say a car or furniture or a large television or expensive sound system, you build a positive credit history. And it also helps you pay for unexpected expenses. You may have expenses associated with those purchases that can be worked into the actual purchase. Some of the cons of using credit, of course, in upfront, interest adds to the total cost of what you're borrowing. Repayment limits the money you have. Repayment also limits the amount of money you have to use for other goals you might want, and failure to repay loans or borrowing negatively affects your credit history going forward. Now let's talk about a bit the borrowing types of credit, and let's take a deeper dive into the types of credit, fixed and revolving. Knowing the difference will help you decide what type of lending makes most sense for your situation, whether it's a personal loan, line of credit, or a credit card. So what is, different types of credit will impact your credit, personal credit history different ways. So what does revolving credit mean? And there is different types of credit. What does fixed credit mean? So let's just talk about that for a minute. Alrighty. So different types of borrowing. Fixed credit, revolving credit, as I mentioned. And we'll talk quickly about that. Fixed credit refers to a loan with a set repayment schedule that is a fixed amount borrowed. You know exactly how much you owe each month and when the loan would be fully paid off. As I'll give you some examples of that would be car loans, student loans, personal loans, and mortgages. Repayment. You make consistent payments over a specific period of time, so we call it the term, with both interest and principal calculated into the payments. Now, the benefit of that is that it's predictability. One of the benefits of it is definitely predictability. You know the amount to budget for each month and when you'll be debt free and when that payment actually it comes out each month. Pardon me. As you can see from the graphic, fixed credit, borrow set amount, use the funds, credit facility paid off and closed. Let's move on to revolving credit. Revolving credit, a little bit different in that you would normally see the revolving credit be in the form of a credit card. Sometimes a line of credit can be that as well. You borrow limit available, you use the funds and you repay them, and they remain available for you again later on. Now, these different types of credit have different types of rates associated with them. So interest rates. So let's just talk about interest rates a little bit. So interest rates for fixed credit are generally lower rates. Fixed credit products such as car loans, personal loans, mortgages tend to have a lower interest rates compared to revolving credit options. This is because the loan amount and repayment amounts are fixed, providing more certainty for the lender. An example, a student loan may have a fixed rate of 5% per year, meaning you'll pay 5% of the remaining loan balance for each year in interest. So what's this mean if when you look at the actual rates in real time? Since we do pay our debts with real cash, it's nice to know what the different rates are based on the type of credit that you use. So a fixed loan rate, as you can see, is 9%. That could be a personal loan. A variable loan rate is showing at this point 6%. However, it could change based on the rate of interest over the course of a year. So if you keep it open, it could increase unless it is fixed. Obviously, you'll see a credit card or what we call a third-party credit where you have more flexibility using revolving credit, but your interest rates are much higher, 19%. As you can see, a line of credit can be 7%, and that is similar to a variable rate loan, but except you can reuse it over and over again, and that's why you're paying a bit of a premium on that. And you can see the lowest rate, and sometimes this can be 5% or less, is a mortgage. A mortgage then is usually secured by property and house, and therefore there's less risk to the lender in the event of a default. This will generally generate a lower rate. If you'd like to take a minute and stand up and take a quick break, that would be great. And let's move on to another interesting topic that is something that we all should be aware of, and whether you're just starting out in credit or throughout your entire credit life, and that is your credit score. So your credit score plays a huge role in your financial life. And I'll open up the graphic for you so you can get a little look at see how things look when we talk about credit score. And I'll give you some background on that. All right, there you go. So your credit score does play a huge role in your financial life. Scores range from 300 to 900, with 600 or higher considered creditworthy. Improving your score is possible with time and effort. A good credit score can open doors to better financial options. Improving your credit score is also possible with time and effort, and it's never too late to start rebuilding your credit score. Your credit score impacts your ability to borrow and the type of rates you receive. A higher score can save you thousands of dollars over time, and that's why managing your credit and keeping debt within your means financially is very important. As you can see here, Less than 600 is considered to be a high risk. That could be someone with a high level of debt usage. So if you had 2 or 3 credit cards and those credit cards were at their maximum limits consistently, you might see your credit score drop down because their concern is that you are not paying off your credit that you have open and perhaps it's beyond your means to do so. Between 600 and 700, you're considered credit worthy. That's sort of, you're paying off your debts well, managing things, but you've got maybe a little more debt than you should have, or you've had a number of inquiries on your credit bureau, which can also impact your bureau because you're borrowing more on a more regular basis from different lenders. Between 700 and 800 it should say very good score, especially as we move towards 800. That's a very strong score, and it tends to demonstrate to lenders that you're a good credit risk, and you also have a sense of understanding of your credit. Over 800 is an excellent score. We do see those certainly from time to time, and normally that's someone that has well established their credit, understands their credit very well. It's not generally an age matter. It's a lot of it is just an education of themselves and understanding credit and understanding how to use credit effectively. So obviously credit score is very important, and managing that credit score can determine a lot of how successful your financial life will be. All right. So how to maximize your credit score. So I'm going to give you some tips here. It's important to check your credit score annually to ensure accuracy. A clean credit record makes it easier to borrow when needed. And it's integrating credit management into your budget ensures that you will avoid unnecessary debt and also unnecessary costs by making sure that your credit score and that your credit record is up to date. Oh, and so here's some of the ways that you can maximize your score. And we talked about scores between 300 and 900. And how do you get towards that 800 range, which is the most desirable that you can have it? Always make your payments on time. Do not exceed your credit limits. Pay down debt. If you're carrying a balance, keep it below 50% of your available credit limit. That's being aware of reading your bills when they come in so that you make sure you're not overspending. Close cards personally. Do not let credit grantor close the card. So if you're not using the card, make sure that you close the card and confirm that the card is closed in writing. And credit grantors will offer you that as well. And then annually, when you go to check your credit score, you can see that that was closed. There'll be a line showing closed by yourself, and it'll show on your credit score, and then that is removed over time from your credit record. Do not open multiple accounts in a short period of time. As I mentioned, if you are having several inquiries, this could be a sign of desperation, and could also show that lenders that perhaps you're not managing the credit that you have well, and therefore that could also lower your score. It does have an impact directly on the credit score. So be careful opening multiple accounts in a very short period of time. Plan your purchases and plan your credit access. Be focused when you look for credit. So make sure that when you're getting credit for something, that it's purposeful, that it is necessary. It's not random. It's not from an offer that comes in the mail, or if you're walking through Costco or Walmart and someone offers to sign you up for a card, be sure that you have a specific reason for getting that card. Otherwise, you will get additional inquiries, and perhaps you could also lower your score and damage your credit access going forward when you need credit at a different time. So post-secondary and early years. So let's talk just a little bit about how this affects once you're in school, if you're in college or university, and the early years. So we're going to just look at a few different things here that will help. So in the early stages of your life, it's critical to focus on building a budget that balances savings and debt repayment. Many students struggle with managing OSAP funds, spending it all at once, and creating a detailed plan for your money as it comes in. This can really help prevent overspending. So as you can see, we're going to have debt. Of course we are. Debt accumulation is very typical at the stage you're at when you're in school. Next, building your savings, right? You see a little graphic there, a little savings. I think it says retirement and emergency plan. So although you may not be thinking about retirement, it's never too early to start saving money for the future. However, at this point right now, your focus is probably on paying for school, building a good, and should be also focused on building a good credit history that will eventually allow you to pay off debt, which might be in the form of a consolidation if you want to get a loan later on. Or it could just be that you've paying down your debt and you've saved enough that you've got that available for when you finish school and you can start to move into the better credit. You can see another graphic here that's building a good credit history, and you can see how we show it a little bit more in detail of poor being 300 to 559, fair being 560 to 659, good being 660 to 724, very good 700 to 725 to 759, and excellent 760 to 900. So it's a slightly different than the previous screen we showed, but very similar in its entirety and how you build your credit and what you can expect to see once you know what your score is. All right. So your financial health, this is important. Financial health is a journey. It's not something you start out with the first day you get a credit card. It's not something you get when you get your first loan. Having some of these details and having some of these in your day-to-day mindset really helps you get to that financial health stage. It's no different than learning how to run a marathon. The first time you go running, you're winded after, running 100 steps, and eventually you get very good at it, and eventually you can run a marathon if that's what you so desire. Financial health is a journey. It's never too late to start, whether you're just beginning to think about savings or preparing for retirement. We are here locally for you to help. And if you want to take any steps that make sense and you want to talk about it, obviously you can drop by our branch. We would love to talk to you about that and keep the conversation going. Showing everything you saw today in regards to learning about credit and how it impacts your day-to-day life is very important. And I do encourage you that if you have access to this presentation and you have any questions you're not sure, please rewatch certain sections just to be able to identify exactly what is most important to you at that time that you're exploring perhaps getting a credit card or getting a car loan. Normally at this time, we would like to open for any questions. However, I would also invite anybody that would like to come and visit us here at the branch. As I mentioned off the top of it, my name is Gene Miles, and I have a very competent staff here at our branch. We're located at 945 Stockdale Road in North Bay. We're very familiar with our market, and we would love to see you. We're just down the hill from the college, and at this time right now, we've covered a lot of information about various things, but we've kept it fairly rudimentary because some folks may have been exposed to a credit card before, but not sure about the credit score, not sure about the rates, not sure about how to use it. So we would love the chance to talk to you here. If you have any questions, please feel free to come in and see us here at the branch. For more information and any questions you might have regarding this presentation or your specific situation, I've also supplied my personal or my work email here. You can reach me here at gmiles@myreport.ca. I want to thank you for your time for watching this or attending this presentation. Thank you very much and have a great day.
Thank you very much, Jean and Bobby Joe, for putting on this session and all of the wonderful information you've passed on.
Hopefully that's good for, there we go, get that out there. Thank you very much for having us, and we appreciate it very much. Thanks, Noah, for attending. No pressure.